Everyone, should we get started? Does everyone want to take? Okay, we're doing a few more hellos and greetings. Yeah. Okay, should we get started? Welcome everyone to the EUI and the RSC. Most of you are, of course, from this very center, so you don't need to be told that this is a lovely venue to be spending the next couple of days. So maybe we'll wait to kind of go into too much detail about the conference or stroke workshop, just because not everyone in this room is attending the full thing, and it might be a bit too much information, and instead just focus on the keynote, which Benjamin Brown has very kindly come to give, and we're very excited to have him, and also to have Eric here as a discussant. So just to introduce Ben, who I guess most of you have either met or kind of read a lot of his work. Ben has just joined the LSE as an assistant professor in political economy. He works on, as many of you all know, the financial capitalism, macrofinance, and as well as the green transition. And he is currently writing a book on wealth regimes, which I believe is the sort of an extract from which he's presenting to us today. And in response, Eric will be providing some comments. Eric is, of course, director of the Schumann Center and needs less of an introduction than Ben, but I can give you some context into how we got Eric here. You sort of send messages to his assistant about every month for a year in advance, and eventually the assistant will be like, okay, we've got the time and Eric is going to do it. And while we couldn't get Eric to give his own paper, which would have been really cool, we did manage to get him to come and give some feedback and responses to Ben's paper, which is really great. So thank you so much, Eric, for your time this morning. But in the meantime, without further ado, Ben, thank you so much.
Thank you for having me.
Sorry, one more thing, but we have new microphones just for everyone. Maybe we'll say this now. One button is to turn the microphone on, and then you click again when you finish speaking to turn your microphone off. And I think only one works in one at a time. And also, can we just check how long Ben is speaking for, and then how long Eric will provide comments, and then also, I guess we'll open for general feedback and discuss. How long do you think you'll? Okay, so if we aim for sort of 35 minutes of your presentation, 10 minutes from Eric, and then we'll have some time for kind of questions and discussion from everyone in the room.
Yeah.
All right, great. I started sharing the screen and I think it's already recording, right? Okay, great. And now I will try to click forward on both of these screens so I can see my notes. I will speak about, so first of all, thank you for inviting me to this conference and speak about wealth regimes, which is broadly within the remit, I think, of the topic of the conference, but maybe diverges a little bit. But I think that, hopefully there will be something that produces some discussion about mostly financial integration, I think, more than fragmentation from this perspective. But then it would be also very interesting for me to see how this plays out more in, let's say, the banking side of things during the conference. I will only speak about the asset management side in my talk. So why speak about wealth regimes at all? There are an infinite number of answers to that question. I will just give one that is related to the place we're in. There is this paper that some of you may be familiar with by Barone and Muccetti from 2021, who find that being the descendants of a family at the 90th percentile of the wealth distribution in 1427 in Florence, instead of one at the 10th percentile, entails a 12% difference in real wealth today. Now, there are probably many issues with this study because they do this via rare and common surnames and so on. But it's if you want to give an example of wealth preservation over time, which is what I'm concerned with in this talk and in the broader book project of which this chapter basically that I'm presenting here is a part of, then places like Florence, or maybe Florence is the place in the world with the most dramatic illustration of why wealth preservation over time matters from a distributional perspective, from a political economy perspective, and so on. So, where is wealth? This is sometimes actually not as easy to answer as it should be. Just very briefly to situate my perspective in the broader literature. And most of you will be familiar with Piketty's work on private wealth. And what you see here is that, or the problem that I would like to point out is that from Piketty's net wealth perspective, the lion's share of the top 1%'s asset remain invisible. And I'm talking, of course, about financial assets, and that's because one person's asset is another person's liability, and therefore it cancels out. Financial assets cancel out in this perspective. However, if we want to know whether R greater than G the rate of return on capital being larger than the growth rate of the economy, where that comes from at the level of individual wealth owners, then we certainly do need to take financial assets into account, even if in an aggregate view, they cancel out. Just to illustrate this point, I want to show you two charts before we get into historical wealth regimes. This is the distribution of income sources in the United States today across the income distribution. Does this point? No. Across the income distribution on the x-axis from very low to 10 million or more. And what you can see is that, what you can see is that for the lowest income households, this is first social insurance transfers, and then for almost everyone in the distribution, this is income from wages and salaries. However, once you reach the 5 million a year income threshold, and here we are already in the top 0.1% of the income distribution, of course, the main source of income is from capital, and is actually the single main source is capital gains. Now, that's not even the highest degree of granularity you can have from IRS tax data. Every 3 years, they do a special study that reaches into the highest echelons of the income distribution, going all the way to 50 million or more in annual income. Okay, so we're here in almost or kind of a billionaire territory. And here you can see the two green items are business wealth, closely held stock in corporate businesses and non-corporate business assets. And you can see that these less liquid, closely held shares in businesses account for only 1/3 of the wealth of the super rich in the US, whereas billionaires hold 2/3 of their assets in the form of financial assets, bonds, equities, retirement assets, and very importantly, private equity firms, hedge funds, and other limited partnerships, both as general partners in these funds and limited partners, owners and customers of these funds. We'll get back to that later. So I just wanted to show you this, that financial assets, which cancel out in the Piketty perspective, are the lion's share in the wealth portfolios today of the very rich. They are also, of course, the lion's share in the assets of large institutional capital pools, which I'm also concerned with in this project. And the asset managers who manage these holdings for both rich individuals and institutional asset owners, the money they manage comes roughly 50-50, very roughly speaking, from the very rich and from institutional asset owners such as pension funds. We will return to this later. So when I speak about wealth owners, I kind of always mean both the very rich, seen here, and institutional asset owners that manage the wealth of the middle class, the better off parts of the middle class, at least, so pension funds and so on. You know, what we're as junior academics basically aspiring to one day having a little pension fund. All right, so what is a wealth regime? I would like to propose this argument that we as political economists especially are very used to conceptualizing the financial sector, its role as a financing role. Finance as a source of more or less patient capital to finance the non-financial corporate sector. However, this is only one way of looking at finance, because on the other side of the financial sector balance sheet, on the liability side, for those who like to think in balance sheets, this is always other people's money, and there is an asset management function involved, which is highlighted here in this quote by Michi, an important financial historian. So an alternative perspective is to look at the financial sector as a provider of asset management services, one, and a shaper of the economy to suit the needs of wealth owners, two. And these two dimensions I will return to in a minute. So a wealth regime would be a reasonably stable institutional configuration that governs the relationship between wealth owners, asset managers, and the economic activities from which returns on wealth are generated. There is a long cycle theory looms somewhat in the background, I would say, of my talk and of the chapter that Eric will comment on. So I just want to have this reference here that Arrighi, the Marx, Brodel, Arrighi, maybe there are some Brodel fellows in the room. I don't know. That line of thinking is certainly an important influence on this idea of wealth regimes. And the questions that I'm interested in is how is wealth accumulated and preserved? What role does finance play in that? And how does asset management shape non-financial economic activity in the process? So before I get into a typology of wealth regimes, just very briefly, what does the investment chain look like today? In the background of this typology is a concept of the investment chain. So I wanted to bring everyone on the same page on this before I show that. And the idea is that on the left, you have ultimate beneficiaries, households. On the right, you have issuers of securities, bonds and equities. States also issue securities, of course. So it's all non-financial actors here, mostly states and corporations. So you have a chain of intermediaries in the middle. First come institutional asset owners. Those are sovereign wealth funds, endowments, foundations, pension funds. Insurers are also in this column, usually described as asset owners. And then you have asset managers. So asset owners versus asset managers. Asset owners are mostly not-for-profit institutions set up to manage institutional capital pools, with the exception of insurers that are a sort of hybrid case. They are for-profit companies, of course. The asset managers are for-profit private companies that provide services to the entities on the left-hand side. You can think of the institutional asset owners in the households. They hold the fund shares issued by the asset management sector, which these fund shares on the liability side of the asset management sector. On the asset side of that sector are the shares and bonds issued by the non-financial sector. So this is, you can also read this here. If you draw a line through the middle of every entity, the actors on the left are on the liability side of the balance sheet, the actors on the right on the asset side. Okay. This is important because here in this 2x2, I have the upstream dimension the idea is that wealth owners always want diversification and liquidity. Yeah, that's at the portfolio level. And then these portfolio level characteristics of a wealth regime are on the left-hand side here. Notably the degree of diversification and liquidity, which is achieved across wealth owners' portfolios. To the extent financial intermediaries are involved in a wealth regime, and that's not always the case historically, what I call the upstream dimension is about the relationship between wealth owners and the liability side of those intermediaries. So that's where diversification and liquidity is achieved. How well diversified across different funds are wealth owners and how liquid are those fund shares. The downstream dimension to the right in the investment chain captures the relationship between the financial sector and the non-financial sector. And here the involvement can be high or low. And the idea is that finance has become ever more involved in the organization of the non-financial sector over time in capitalist development. And today we talk about this mostly as corporate governance, right? Asset managers hold shares and then they vote, they are involved in corporate governance. Private equity is as important as public equity today, if not more important. There, we don't usually talk about corporate governance, but that is the same idea, of course. There's corporate governance also there, except it's not in private equity markets, but in public equity markets, but in private equity markets. So here are 4 different wealth regimes, how I would slot them into this typology, and I will go through those in more detail in a minute. The idea is that landed capitalism, sort of the oldest form of capitalism here in this version, there's not much diversification or liquidity in the asset portfolios of the very rich, and you don't have a lot of finance involved. Versus today, you have high diversification and liquidity and lots of finance involved. And in between, there are some other stages that I will talk about in more detail. So here's a different view of this, the 4 regimes on the left, and then some key features in the 4 columns. The dominant asset in the portfolios of the very wealthy in these different regimes, who performs the asset management function, the diversification, sectoral and geographical of these portfolios, and the liquidity. And then maybe the last version, the last column is speculative, and I'm not going to talk about it really. The idea is decidedly not that these are, phases of capitalism that conclude and then a new one begins. Clearly, land for many wealth owners is still an important asset. It seems that a lot of plots of land here are quite large. And unless these are all billionaires, I would assume that a significant portion of these landowners' wealth is bound up in their land here, at least judging by the length of the walls that you walk by when you go from A to B. So land still plays an important role, but of course, in a different way than before, because it's not like there are villages toiling on those lands and the return on investment comes from that. It's more the appreciation of the asset over time, of course. But still, there is a temporal sequence, of course, to these wealth regimes. So with landed capitalism, the portfolios of wealth owners are poorly diversified and illiquid. Financial institutions play no significant asset management role. Financial institutions are, of course, involved when you read novels about landowners in the, 18th century. They're always cash-strapped and they need to borrow a lot of money. But in terms of asset management, there's not much involvement. There is, of course, estate stewardship as an asset management function that is performed by individuals for large landowners. That's not really a financial sector function. It's more a managerial function. Empire is is an interesting case. Many financial techniques were developed. A lot of financial innovation happened under the empire wealth regime that are still around today. European imperialism developed alongside financial markets, especially in the case of the British Empire, of course. There were vastly increased possibilities of portfolio diversification, notably via sovereign debt and also via the securities issued by colonial enterprises, such as the Dutch and British East India companies. Finance capitalism is a very close predecessor to asset manager capitalism. It didn't so much improve diversification, I would say. The sectoral and geographical concentration of these robber baron portfolios in the US, they were often steel. They had a steel monopoly, an oil monopoly, and they were very much national. So sectoral and geographical diversification was not so high. But finance capital brought a much higher involvement of the financial sector in the non-financial economy. I'll get to that very soon. And then the same for the last row, which we'll get to towards the end as well. So that's just an overview of how I would think about these. And now I want to just give you a few vignettes and examples to fill this with historical detail. So Florence, I would have liked to talk about Florence, but Florence, the Republic and then under the Medicis is like a little bit unusual in the sense that there was not this medieval corporatism that in many other places developed in city-states and the Hanseatic League and so on. It was more sort of decentralized, it seems, from what I understood. But Venice is really a great example for basically a state that was also an asset manager. So the main asset for wealth owners, the main financial asset was the public debt of the Republic of Venice. That arrangement existed elsewhere too in the Italian city-states. It was a pure oligarchy. The wealth elites that subscribed to that public debt that was issued and administered by the government, which in turn was run by the same wealth elites. So the Republic itself performed the asset management function, if you will. It was an institutional capital pool, asset manager, and a militarized trading company all at once. The Venetian traveling to the Levant on business was likely to go in a state-built galley commanded by a captain chosen by the state within a convoy organized by the state. And when he reached Alexandria or Accra, he might well be ordered to join other Venetians in a joint state-organized purchase of cotton or pepper. So it was a highly integrated operation, and everyone was sort of bought into it as a shareholder in the common debt. It was a major component in the asset portfolios of these households. So for example, in Genoa, 1/5 of the income wealthy households received was from their holdings of public debt. So this was a very large share of people's portfolios, actually. Now, if we move ahead to the next imperial configuration, or we jump the Dutch hegemonic cycle, we move to the British one. And what we have is that the joint stock company share becomes an important asset in wealth portfolios of metropolitan elites, the main asset traded on the stock exchange in London. Same in Amsterdam, of course, with the Dutch East India Company. Basically, the stock market is about the shares of these companies. And these state-chartered companies, which are a sort of institutional capital pool, they allow metropolitan wealth owners to profit from slave trade, colonial exploitation, and so on and so forth, while holding these highly liquid shares. To profit from distant imperial colonial projects. There is later on an interesting further financial innovation, which is very close to how we do asset management today. And this is the Foreign and Colonial Investment Trust, which is still around under the name FNC today and is still advertising its long and illustrious history of investing in so-called emerging markets as early as 1868. This quote here on the right is from FNC's website today. And the purpose of this first or second, the Dutch invented the first mutual fund is almost 100 years earlier, but then the Brits reinvented it, and it stuck around this time. The express purpose of this financial innovation was to provide cheap access to securities for a wider range of countries and for a broader range of the investing public. So greater diversification for a greater share of the so-called investing public. And that is to this day, of course, the purpose of the mutual fund and its latest incarnation, the index fund, which is even cheaper. So yeah, chartered companies, colonial companies are gone, of course, but joint stock corporations are still around, and equities are still around. Mutual funds are still around. So these innovations really matter. I want to now spend a little bit of time on finance capitalism and how it worked, because it's really an important step, I think, towards a greater involvement of the financial sector in the organization of the economy, the reorganization of the economy. So before 1890, now we're in the US, okay? The final hegemonic configuration. We're not moving on to China or anything like that today. Oh, sorry, thank you. So before 1890, Wall Street banks did bond and stock issuance for industrial companies, but they not many, and they certainly did not hold equity in industrial companies. They were really two separate worlds. Most stocks in railroads and industrial firms were held by families or small, locally concentrated groups of shareholders. This was a very much a decentralized economy with lots of local industries, local railways owned by local elites. The 1890s see a very interesting development, the emergence of what has been called Morganization. Okay, so here again, the main asset is corporate equity, corporate stocks. The asset management function is performed by these private banks, which we would today call investment banks, which previously would have been called merchant banks, but these are more or less the same type of financial actors. And the main financial innovation maybe now was this process of Morganization, which I will explain. The result was that JP Morgan and other banks came to direct large parts of the US economy that they had themselves reorganized into a more concentrated form. And the asset management function of finance really takes center stage in this. As noted by one biographer of the Morgan Bank, Ron Chernoff, Pierpont Morgan's power, quote, is not to be found in the number of his own millions, but in the billions of which he was the trustee, which of course is the same, could be said about, Larry Fink as the CEO of BlackRock. This is all other people's money, but they do control the votes on these shares. Now, what did Morganization entail when it comes to the involvement of finance in reorganizing the economy? It was about increasing profits by limiting competition among different railroads first, and then among different companies in the same industrial sectors later on. And it was a sort of a switch in the mode of economic coordination from market competition between firms to non-market coordination within much larger entities, or even between, so inter and intra-firm non-market coordination under the direct supervision of bankers who sat on the boards and who controlled shareholder votes. George Perkins has this memorable quote asking the rhetorical question: what's the difference between the US Steel Corporation as it was organized by Mr. Morgan and a Department of Steel as it might be organized by the government? This was a time when socialist organizing was still a real prospect, or maybe was in the offing as a potential future. And Morgan understood its own work in those terms. We're rationalizing the economy, but we're doing it as private actors for private wealth owners, not as the state. Okay, I should limit this. I already spoke about how these portfolios were quite concentrated, illiquid, and still not internationally diversified, and so were somewhat vulnerable. All these robber barons did not, they diversified eventually. And if you've ever been to the US, or there are a lot of philanthropic bodies, foundations that carry these men's names, and all that wealth, most of that wealth was safeguarded via diversification. Okay, so the famous dispersion of shareholdings in the US that followed on this period was a mechanism through which these robber barons that had built these empires with the help of bankers diversified their portfolios into something resembling, I think, present day portfolios, which are sectorally and globally highly diversified. Now, there's not much time left, just 5 minutes. I think that from this perspective, we can conceptualize asset manager capitalism as the first wealth regime under which a sophisticated global asset management sector offers wealth owners full diversification across sectors and geographies via relatively liquid fund shares, while simultaneously being involved in the management of economic activities in the non-financial sector. This involvement takes the form of active participation in the governance of corporations, as minority shareholders in the case of public equity or majority owners in the case of private equity, but also increasingly, of course, as owners of infrastructure assets or assets that would be vaguely previously have been thought of as part of the public infrastructure, energy, water, land, housing, and so on. The profits of the asset management sector are the price wealth owners pay for the historically, I think, unprecedented advantages this wealth regime affords them, because it allows them to diversify to liquid shares and funds, and yet at the same time to benefit from the to reap the benefits of control, which historically you could either have one or the other, diversification or control. But because these asset managers are very large capital pools, you can spread your money across many of them, and yet each of them is able to exercise significant control over the companies they hold in their portfolios. And as a wealth owner, you pay the asset managers, but you still benefit from that level of control. I just want to, maybe let's skip this and briefly jump through this. This is the rise of institutional capital pool part of the talk. I just want to, sorry, I'm getting confused with my two clickers here. I want to briefly show you whose money is managed by the private capital side of the asset management sector. I had mentioned that it's roughly half-half, okay? Let's go to the two sources that I had mentioned, the super rich and institutional capital pools. This is data on family offices asset allocation. So family offices are staffed with financial professionals, and they manage the financial wealth of the super rich. They are in-house asset managers, if you will. And this is an annual survey from UBS. And what it shows is that family office portfolios in the United States are heavily tilted towards high-risk assets, okay, so equities. But the weight of equities is 28%, whereas private equity is 35%, okay? So, and this allocation, this increasing, they are ahead of institutional capital pools, but private equity has become the main asset class for the super rich, as shown in this, and not just in the US, but to a slightly diminished extent also in the rest of the world. These portfolios do not look significantly or radically different across the world. Now, the second source of money for private equity, as I said, are institutional asset owners, the ones that manage our pension funds. And I just want to show you how this has increased over time for the, usually the US are ahead. The US public pension funds are the largest pension funds. The largest pension funds are furthest along in this transition into alternative asset management. But you can see the same in the Netherlands, in Denmark, in Switzerland, the same trend into alternative asset management by pension funds. This is the biggest US public pension funds in 2001, their allocation to real estate, private equity, and then total alternatives alternatives being real estate, private equity, and hedge funds. Here you have hedge funds that become more prominent in the 2010s. And today we have alternative allocations that basically mirror the portfolios of the super rich, where you have all of these alternatives combined account for about 50% of the assets of the largest pension funds today. So and the two sort of, I like to think about this. There is as two separate but highly related developments. You have a sort of collectivization of private wealth in the sense that private wealth owners, the super rich, pool their money in these same few asset managers. There may be 10, 20 top global private equity firms, and they all manage money for all of these pension funds and for most super rich families. So there's a collectivization of private wealth, while at the same time, there is a privatization of public money through these pension funds. And of course, sovereign wealth funds as well in other countries. Increasingly, countries either have a very large pension fund sector or they have a very large sovereign wealth fund, or several of them, who invest in very similar ways. So you have these two developments that end up in the same in the same collective asset management vehicles. All right, where does that leave us? Some concluding thoughts that are more suggestion for discussion topics. Barron and Sweezy, the Marxist economists, who last week were credited, or at least Barron was, for having preempted the Nobel Prize winners' arguments by some margin. But anyway, they famously argued that the managerial companies of the post-war era that were sort of described as kind of a benign version of the corporation, that they were not a managerial ersatz government, but, quote, a more rational calculator than the small-scale capitalist entrepreneur, and therefore a more effective profit maximizer than smaller companies. So they went against the argument that managerialism had brought about a more benign version of the corporation. And I think this is a helpful way of thinking about the role that the institutionalization of capital plays. These institutional capital pools, both the owners and the asset managers, have rationalized return generation. The overriding goal is to create steady returns from as diversified a portfolio as possible, and to reorganize the economy in order to deliver these returns, right? And I haven't been able to go into this, but many of you are familiar, of course, with the literatures on financialization, on corporate governance, on what private equity does when they take over companies. I was more trying to present to you a sort of historical framework for making sense of this role played by finance and a particular type of financial actor, namely asset managers as opposed to banks. Wealth preservation in this wealth regime is the primary, or today is, I would say, the primary function of finance. The planning power of finance is geared towards creating steady returns rather than, allocating loans to risk-taking Schumpeterian entrepreneurs. And then as a result, and this is the most speculative of the hypotheses I would like to feed into the discussion, is that we're in a kind of, that this regime clashes with both available modes for economic coordination, with the Schumpeterian risk-taking and creative destruction by private capitalists, decentralized capitalists, and with state-led planning and coordination beyond the profit motive, because of course that leads us into the whole arguments about de-risking and so on. These institutional capital pools prefer a mode of coordinating and governing the green transition that leaves them the task of allocating capital and just are asking for subsidies that indicate where the state would like them to go. Thank you.
Well, I have to say, Ben, I think this is a brilliant project. And I don't really have anything critical to say of it. Rather, I think what I would focus on would be to try to push you a little bit to boil it down to some very basic concepts that I think people need to grasp in order to appreciate the significance of what you're trying to say, right? And one of the things I found most striking in the first chapter, which is the one that I read, is that at no point do you actually define what wealth is. And the reason that I think it's important for us to define wealth as some kind of asset that generates revenue over time, right? Either in the form of some continuing payment or in the form of a capital gain, is because understanding wealth in that sense gives us, I think, a better understanding of the economic processes that lie at the heart of this arrangement, right? There has to be some real economic process, some growing food on the land, extracting minerals from the soil, some economic process that generates this income over time. And then we can bring in the part that you find more interesting, which is the way we make this liquid, right? And the liquidity aspect of this is all about, to a greater or lesser extent, dematerializing that real economic process. And we're going to dematerialize that real economic process by representing it with some kind of financial contract, right? In this dematerialization, this introduction of liquidity is hugely important because the financial contract has to represent, to some extent, that real economic activity that generates income over time, right? And it can represent it either directly by mirroring it in almost precise form, or it can represent it indirectly by creating the opportunity to benefit from the fruits of that real economic activity, right? And then we have the management issue, right? Because when you talk about asset management, what you're really talking about is the maintenance of two different sides of the relationship. And you do this graphically in your presentation. It didn't show up in the book. And that is to say, the management has to ensure first that the dematerialized representation remains somehow connected to the real economic activity. And second, that it has to somehow continue to deliver income or purchasing power to whoever holds it, right? And it's in that context where the wealth owners are holding these dematerialized assets and expecting this revenue to come to them, that you get to this elevated form of asset management that you describe as the wealth regime at the end, right? Where the asset manager is not simply responsible for ensuring that the dematerialized asset connects to the economic activity, but is also responsible to the stakeholder on the other side of the transaction for ensuring that the dematerialized assets or the pool of assets continues to generate some kind of economic return for the people who hold their wealth in those assets, right? Okay, now I want to clarify all these things because your different wealth regimes actually have the asset managers focus on one or the other side of the dilemma, right? They can either focus exclusively on trying to appease the rich, the rentier class, without caring about the underlying economic activity. But then that raises questions, how are they going to generate the purchasing power that they can transfer? Or they only care about connecting to the underlying activity, which raises questions, how are we going to protect the wealth of the wealthy, right? So think about the Lloyd's syndicate, right? Where there's 100% personal liability. They're directly connected to the insurance business, but if it goes belly up, then boom, right? All their wealth is evaporated. And 100% liability exists all the way up through much of the 19th century for many of these financial instruments. So we could argue that the asset management or the wealth management that was taking place, the wealth regime, is one that is really focused on just maintaining this link between dematerialized assets and underlying economic activity without any concern for the people who hold the dematerialized assets, okay? Now, why would we want to do that? I think this is the part of the story that I'm missing, right? Why do we want to dematerialize these assets? And I brought along Herman Schwartz's book on states and markets, because Herman has a very discrete argument. He says, we want to dematerialize these assets so that we can tax them, right? I mean, if you think about it, if all your wealth is tied up in the land and you're the sovereign and you want to tax the wealth of these wealthy landowners, how do you get that wealth away from them and bring it back to the capital, right? If you can't dematerialize, it's not like you're going to dig up a big chunk of Lincolnshire and bring it down to London, right? So the only thing you can do is to force them to have a dematerialized asset that you can then collect in a big sack and bring back to London. That's Herman's argument, right? And so the dematerialization of assets, the introduction of this notion of dematerialized wealth is essential for tax revenue, right? And indeed, if you look at the way coins are minted and why coins are minted, you discover that the mint itself is a tax instrument. You force people to use these coins. You require them to use these coins so that you can get the seigniorage from the coins, right? And then you can tax the coins that they use. And then the issue becomes, okay, if we're going to use these metallic coins, that has a liquidity issue because they're weighty and because they're hard to use. And so we might want to dematerialize it one step further, which is why I brought this other book about how a ledger became a central bank. The way the fathers, the city fathers in Amsterdam did the next step of dematerialization was to create a bank that was responsible for ensuring the value of these material coins. And that meant creating new financial instruments altogether, bills of exchange, but also ledger entries that are purely dematerialized assets, right? And so as you keep doing this dematerialization, again, the point is taxation. How do we tax the people who have wealth, right? But then it also becomes trade and insurance. How do we finance the way goods travel across the world, and how do we protect against the fact that those goods might sink into the ocean, right? And so this dematerialization of wealth becomes essential to engage in trade and to provide the insurance to make sure that the people who do engage in trade don't keep blowing up every time a ship sinks, right? And I think that this motive becomes really important because as we're going to move into the joint stock corporations, we have to ask ourselves why we want to have limited liability. And again, it's to be able to accumulate assets so that we can finance industrialization. So there's a motive that's attached to that. The unintended consequence of all of this dematerialization is the accumulation of wealth in the form of assets that are only loosely connected to these underlying economic activities. That's the Walter Lippmann story from Drift and Mastery, right? Back in 1914, when Walter Lippmann wrote the book, he said, the reason that we have all these problems in the United States is that we now have all these wealth holders who are disconnected from the economic process, right? And the only thing that connects them are the asset managers, the people who ensure that the assets they have are connected to the economic process. And the problem is these asset managers are actually defeating the original purpose. They're hiding all this wealth from tax. And so we need to get our ability to look into it, which is where you started your story, right? Because all these assets exist as contracts with two counterparties, right? And so they effectively disappear, particularly when the value of the asset in terms of income is generated through capital gains. You have to be able to observe the transaction. And by the way, your data shows perfectly that most of the value that the super rich are extracting is in the form of capital gains, right? Then you have to really work hard to observe all of these transactions if you're going to get the capital gains and tax it, right? And the way we do that is by lowering the rate of taxation on capital gains so that there's an incentive for people to reveal them. But unfortunately, that means that the super rich are investing in private equity for a good reason, because private equity has carried interest, which is all effectively deferred capital gains, right? So I think there's something really interesting going on here. But there's something interesting is something terribly self-defeating, because at the end of the day, we want to use this money for the public good, right? And how do we do that? Well, what Lippmann argues is that we've got to go back and figure out how to tax, but not just how to tax, how to use the money for industrial policy. So get the state to go in and begin directing by manipulating the structure of these contracts, begin directing the liquid forms of assets in order to push economic activity into areas where we want, real economic activity in areas where we want. By the way, this is exactly what Mario Draghi is trying to get us to do. If you read the Draghi report, it's all about pushing financial capital in ways that will invest in underlying real economic activity in areas that we want. So now we've gone from tax and trade and insurance and investment into industrial policy. And this is what the progressive agenda that Lippmann argued about in the early 20th century and that Draghi's arguing about right now is focused at. So the interesting thing about your wealth regimes is that the more the asset managers become central, the more susceptible they are to capture by the state and redeployment into industrial policy. And by the way, if you read John Zeisman's work on France, that's exactly what you see, right? And as we move into that, I think that's what we should expect. And the reason that I think that, and this is where I'll finish, is because so much of this otherwise previously private activity is being brought into the public domain. Think about the new operational framework for central banks, both in North America and in Europe. That new operational framework has central banks running massive positive balance sheets and intervening directly into financial markets, and then using that direct intervention to distort the relative cost of capital depending on which sector you want, right? This is Jens von Klooster's focus on green finances run by central banks. But look also at the extent to which non-bank finance, these alternative financial managers, the shadow bankers, are being brought into the public domain by giving them access to central bank liquidity in times of distress. And the more they get access to central bank liquidity, the more we should expect to see the same regulatory regime applied to banks extend to encompass these non-bank financial institutions. And in many ways, we're going to end up with a different form of financial repression as the state controls all of these activities by bringing these formerly club-like entities into the public goods domain. And I think your analysis shows this in an incredibly powerful way by helping us to focus our attention on wealth, on liquidity, and on the management features, right? With the real question at the end of it being, okay, how do we maintain trust in all of this? The tragedy in this book about how a ledger became a central bank is that the Bank of Amsterdam, which was so pivotal for much of the 17th and 18th centuries in running the global monetary system, lost the confidence of the people who used these dematerialized financial instruments it created and then disappeared from activity, right? So suddenly you had it and then you didn't. And I think your book promises to reveal some underlying dynamics in the financial system that previous work has not demonstrated effectively. So thank you very much for it.
Now you can see why I was keen to get Eric to give a full paper, because that was a very rich set of comments to a very rich and informative paper. A firework, yeah, exactly. Not discussants, but fireworks. Thank you so much, Ben and Eric. So I guess we have about half an hour. I think, just double check that I got that right. Yeah, we have half an hour now, in which I'm sure there'll be lots of discussion and questions and comments. And Jonathan has his hand up first. So let's start with Jonathan and then go from there.
Who know me, that's a personality trait that I like to ask a question at the beginning. A very fascinating presentation. So I have, broadly speaking, two sets of comments or questions, one at the very beginning of your historical arc and the other at the end. I mean, it's kind of a pity you ran out of time and didn't get to go more into the asset manager. So I'll start with the comments about the current situation. So I don't know how much you're going to really go into this in the book, but there are a whole set of very interesting questions and debates about what do these asset managers really do, especially vis-a-vis the real economy. And of course, you present several different types of asset managers. There are the private equity funds, there are the index funds, there are the hedge funds, and each of them operates in somewhat different ways. So, I mean, as regards private equity, there's some private equity from the point of view of the people who invest in it is very expensive. And there's a lot of question about whether it's good value for money, given how much the managers skim off of the profits. I wonder if you can say anything about that. The other thing that I think is interesting about private equity, I looked into this about 10 or 15 years ago in the US when I was doing some work on supply chains and finding that many small and medium-sized manufacturing companies in the US who were engaged in global sourcing were owned by private equity firms. And what looking at the literature showed was an incredible dispersion of the rates of return of private equity firms. And it was, one could conjecture, there was some evidence for this, that those private equity firms that really intervened in the management of the companies and possibly also engaged in these so-called roll-ups that are questionable from an antitrust perspective, may be the ones who are realizing high returns. And many, many other private equity firms were not realizing high returns at all. So I wonder if you can say, something about how you see that. With the index funds, there's a different debate, and that is that especially the largest ones, they have to mimic the structure of the equity market. And so they hold shares in a very large range of companies, and it's not very clear what value they add to the management of those companies. And so there have been also some suggestions that they may illegally be damping down price competition among firms that they own. But there's a different kind of question about what is the corporate governance and how does that affect the real economy as well as the returns. And then the comment about your first type, landed wealth, is just something you probably are quite aware of, which is that economic historians, especially of Britain, have shown that the landowners of the 19th century were among the big investors and developers of all kinds of infrastructure, because they owned the land on which coal and steel and docks, but also the residential areas of London were constructed. So obviously, that very quickly turns into something more complicated than the kind of foil that you've presented it as here. Thanks.
Would you want to collect a couple, or would you like to respond to each individually as you prefer?
No, there's also maybe that I will talk too much, and maybe let's collect.
Yeah, let's collect a few and okay, so I think I saw Benedicta and then David. So we do 1, 2, 3, and then Ben can respond in the group to the group.
There we go.
So thank you for the fascinating talk. I have a genuine question, which is how the evolving nature of asset management relate to the evolution of the role of central banks. Because I'm thinking from the 80s with independence, central banks have become quite intrusive. They can change the value of your asset in a second. They don't even need to touch the policy interest rate. They just give a press conference and then they're able to inflate and deflate your assets. So in this context, I'm thinking that diversification and liquidity are ways of getting out of the strong power of central banks these days. And related to that, I add a comment. This was a genuine question, whether the role of the central bank matters and the evolution of the role of a central bank. And the comment is that if Eric is right and we want to put financial capital into the industrial sector, one thing you need to happen is that the ECB, in the case of Europe, stays put. Because if they start moving, they alter, what might be ex ante an optimal allocation of the financial capital.
David.
Thank you. So couple of observations, if I may. One sort of nasty one, and I apologise in the sense that it's quite difficult and I don't know how to do it, but it relates to accounting, and in particular to the fact that some large holders of stuff, if you like, are historic cost accounters, whereas many high net worth individuals are mark to market, largely mark to market. But you'd have a very different view of wealth if, for instance, you marked the Roman Catholic Church, the Crown in England, and so on to market, right? A lot of their land is held on a historic cost basis, and if your historic cost is 1262 or something, you get, quite a low number. And I think that does distort some of the comparisons quite significantly, but I don't know what to do about it. But at very least, I would suggest that it might be useful to have some caveats about that. And in particular, of course, one of the attractions of venture capital is that it isn't marked. So you can hold it at where you acquired the securities, assuming that they're not impaired. And that's a big advantage, not having to recognize those mark-to-market distortions. In fact, I would argue it's one of the few pieces of secret sauce in VC versus the private equity markets is precisely that fact. So there's some stuff going on there, I guess, I'd suggest. And the second thing that you might want to think about is the incentives that the intermediaries create for the asset managers. Now, it's a trope, for instance, that the VCs need to be in, if not every deal, then at least most deals, because if they don't subscribe to some of the smaller, less attractive deals, then the intermediaries won't let them into the attractive ones. So that interest of the intermediaries in moving all of their deals creates some of this indexation pressure that you're seeing, whereby people tend to hold something that's closer to the market because it's simply not possible to be that selective. The same dynamics plays out in IPOs. If you want to be an asset manager that's let into the hot IPOs, then you have to take the cold ones too. So that's a sort of interesting dynamic that I think is also at play here, and sort of partly speaks to these governance questions, that because the large asset managers need to participate in some sense, in many deals, they can't act in a purely Schumpeterian sense that even if they wanted to, argument as to whether they want to, but they can't anyway. Thank you.
Okay, should we, do you want to respond to the three? That's quite three meaty ones. So.
Oh, now it's on, yeah. Eric, for all these comments, and which was really quite, I think you almost elaborated, I think, a whole additional argument that I could bring out here, and I think I will try to do that. Reading these books. So I take all of this on board, and especially I think, yeah, the argument, the role, basically what is currently missing the most, I would say, to boil down your comments once more, is I think the state, right? So and taxation and the fiscal and monetary, let's say, architecture within which these wealth regimes exist and evolve, which is also a question, of course, that came up. So yes, I really am grateful for all of these comments. And I completely agree with you on the that one of the most interesting questions one can ask now is the various attempts to mobilize all this money, right? And talk or write about the prospects for these various attempts and various strategies of doing that. We had a discussion with Waltraud just the other day about this, and I'm quite, maybe just one brief point about this, I'm quite skeptical regarding the prospects for states, especially with large funded pension sectors, to mobilize pension capital for, let's say, green development, green transition projects, without at the same time doing a lot of financial repression, which you mentioned. I think that's, so there is the prospect, but I don't think that prospect can take the form of just, expecting that pension funds have the capacity to move out of private equity, say this is socially undesirable for our members who are workers, and private equity investments generally harm our members, whereas investing in the green transition will actually be very good, because that might mean that in 50 years' time, we will actually have an economy, which is the necessary foundation for any pension payments in 20 years' time, 50 years' time. This is very difficult to make this jump as long as there are fiduciary duty, as long as there are best private sector practice that as a fiduciary, according to US dominant interpretations of US fiduciary law, you have to follow, which is basically, it's very interesting, just one small point. So the prudent man rule, I only learned this very recently, the so-called prudent man rule, prudent person rule today, but 200 years ago it was called the prudent man rule, which implies that trustees of institutional capital pools, any kind, need to follow basically the prudent wealth owners' investment practices of the present day in how they manage the institution's money. That came from US trust law, and it was a case that Harvard College filed against the trustee of a small fortune that was left, that would eventually go to Harvard, for investing it too riskily in insurance stocks as opposed to just public bonds, basically. So very conservative by today's standards, but high risk back then. And so there is this element where the whole architecture of the regulatory apparatus basically is geared towards institutional asset owners such as pension funds emulating whatever the investment practices of the prudent wealth owners are. The way we understand it is that's basically what billionaires in their family offices do, which is very interesting if you think about these historical origins of that. So getting rid of that will require a lot more than just telling pension funds, okay, but why don't you invest, why don't you redeploy 30, 40, 50% of your portfolio from alternative asset managers into, I don't know, green projects that are somehow maybe state subsidized. It will require a lot more. Jonathan, thank you for these comments. I think the index fund point, I want to briefly say something about this, because you mentioned this literature. I think you alluded to it, right? The literature on the anti-competitive effects of common ownership that are very prominent in the finance literature. One thing that I always found a little bit funny about this is that they never refer to finance capital and the writings about finance capital by people like Hilferding and so on, who, that was a form of common ownership engineered by Morgan and the other banks, geared towards lowering competition. And yeah, this is now being reinvented by the asset managers, but it was also reinvented by economists studying it. It's quite an old phenomenon, of course, to do that. And you mentioned roll-up deals by private equity. The logic is the same. You reduce competition by rolling up many competing firms into one larger firm. Private equity is expensive. Is it worth it? I think that's a huge discussion. It must be somewhat worth it because I'm very sympathetic to the argument that pension funds are being, you know, what's the word? Fleeced by private equity, but I cannot imagine that they don't get anything out of it since they're all doing it, and they can't get, you know, the super rich, their conditions can't be that much better than the pension funds to make all the difference. So even if it's just the diversification effect that you get from getting exposure to the non-listed part of the economy, non-stock market listed part of the economy, which is a huge part of the economy, even if it's just that, it may be worth it for owners of, you know, portfolios in the billions and tens of billions or hundreds of billions. Yeah, how the evolution of wealth regimes and the rise of asset managers interacts with the growing footprint of central banks is in a way the favorite question that I've ever been asked for me, because these are my two obsessions. But I haven't thought about it very much. The one thing that I would like to say is that, of course, BlackRock, the largest asset manager in the world, has built a very important line of business by advising central banks and by actually being an asset manager for central banks. So starting with the maiden lane portfolios of the Federal Reserve, when they took over the assets of AIG, the insurer, BlackRock became the asset manager for that. And then later on, they did, you know, all kinds of risk assessments for governments. They helped with QE when governments started buying corporate bonds, and so on. So there is, let's say, the quasi-public functions these asset managers increasingly play. I think you see them most vividly in the growing, I would say, infrastructural entanglements between asset managers and central banks. So I completely agree with you on that. And then maybe we can discuss more in the break. And then, David, I would also like to discuss with you a lot more, I think, because the differences between, you know, in accounting, historical accounting versus mark-to-market between VC and PE, you know a lot more than I, and I would like to hear more from you about that. Yeah, and the last point that you made, the incentives of the intermediaries and how that, because the way I understood you, I've been talking about how these asset managers shape economic activity in the corporate governance process, more or less, right? But what you are saying is they also shape the economy by influencing the allocation of capital, and you know, they tell their clients, we have to go into all these deals if we want to get into we have to get into all these cold deals if you want to get into hot deals. And so it sounds a little bit like this is a theory of why it is so easy to get VC capital, even if your idea by any, you know, prudent person standard may sound absolutely ludicrous, why it's still so easy to to get a lot of VC money. So thank you. Yeah. Oh, sorry.
Great. So I think we had Balthazar first, and then Waltraud, and then Toby. Please, you have your hand up. So Toby third, and then we'll get Agnieszka. So if we do 4, so starting with Balthazar.
Yeah, thanks very much for a very learned, when you see this chapter, an extremely learned chapter. That is just the first one. And then Eric manages to find 4 books that he hasn't cited in this first chapter. It's quite an achievement. So my question is, however, in a way you concentrated a lot, Benjamin, on the liability side of these asset managers. Should we not be more concerned about what they do with it, the asset side, as you say with Morgan, the billions that he has under his control, and how he can shape the economy is the concern. I mean, you look at Kachel there, who is interested in how private equity now goes into rental markets in urban centers and does something with that and shapes these markets. And the second is whether you could briefly elaborate why you think the limit of asset manager capitalism is stagnation. Is that a consequence of that, you say, wealth preservation is their overriding goal? Now, I would say, given that we lived through quite a roller coaster of financial instability, are they then kind of completely complementary to what central banks would like to achieve and haven't done so well in the last 15 years?
I think we had, who was third? It was Toby and then Agnieszka, and then we'll swap.
All right. So first of all, I really like the extension of your asset manager capitalism to wealth regimes. I think that's a really nice move. But I basically had 4 questions about some of the choices you made in the periodization, and that sort of struck me. I mean, the first thing was I was really struck by how in landed gentry and empire you left out people as assets, right? Both in slavery and indentured people. So I was wondering, why you made that choice, and is that an important part of the story? Oh, sorry, yeah, maybe I was just quickly gone. The second point is, and sort of Eric mentioned that, right? This was another thing where in the early times, there was this question of seigniorage, right? That private individuals literally ran what we now consider the monetary system. So that kind of seems to me also maybe an important side of what their wealth consisted in. The last was particularly, whether you maybe understate the degree of internationalization with empire, right? Because at least to me, empire had something about extraction from the periphery to the center. So to me, that's a form maybe of strong internationalization. I don't know, do you see that? And then sort of maybe the sort of last 2 points, interesting, you obviously mentioned the nature of modern credit instruments as liabilities and assets, but now we have the newest financial innovation, various cryptographic tokens, which are just assets again, right? Does that signal a move to another type of regime? And then a last question, which just out of interest, people talk about energy regimes as well, energy regimes, right? Does that link up to your wealth regimes in any way? Thanks.
Yes, so I will try to be contained there. Thank you so much, Ben. This was really thought-provoking, and I spent a lot of time obviously thinking about banking regulation. And I just about managed to kind of have the universal owner ETF discussion, and now I have to expand it to private equity in my head. So thank you. But out of this, specifically my question. So. Partly because I work so much on banking and so much is happening there in terms of regulation. I understand the limits in the kind of financialized capital approach as regulation, but for for your asset management stage, one of the things, and kind of linking this also to the theme of this conference, one of the things I was thinking about is fragmentation, also in terms of regulatory coverage. Because what you see when you look at the kind of the different assets that are owned is that they are covered by completely different regimes, that somehow these asset managers have to contain within themselves. And so on the kind of ETF, universal ownership, these are public markets, right? So lots of disclosures, corporate governance. Banking regulation, again, heavily regulated. And here my question somehow bridges what Jonathan and Benedicta also mentioned, right? So, and then you have the private equity, which is somehow a world of its own, the shadow banking, we don't really know what is happening there. And what I kind of was thinking about from this kind of regulatory perspective is that you have a fragmented world where all of these assets are governed by completely different regulatory regimes, which creates differentiated possibilities for the state to engage. But also the asset managers themselves somehow create a regime for reconciling the less regulated and more regulated sides. And I think, like, what does it do? Does it make private equity more like the more regulated market segments, or does it make the more regulated market segments more like private equity? Thank you.
Okay, that's 4. And I guess it's just before, well, so maybe we have 10 minutes. And so I think Torsten, do you want to add your question now, and then that will probably tide us to the end of the session.
Thanks. Right, so I found this very interesting. But one more general question, you kind of alluded to it, but maybe you can go a little bit deeper, or maybe you will go deeper in the book. How did we get from one regime to the other? That's my kind of one big question I have, and especially, of course, the most recent shift from the, I think you call it financial capitalism to asset management capitalism. And what's next? I mean, I don't want you to put you in the spot here like the next Marx or so, but what is the solution? Where do we go from here? If stagnation is the answer, what do we need, a revolution, or what? And I mean, on the crypto side, I mean, yeah, well, never mind. Maybe related to that, regulatory authorities, I mean, they kind of have different approaches, right? So one is, of course, different tasks. One is, of course, purely prudential. I mean, that's the reason why we regulate supervised banks. Does it have to be extended even more prominently to asset managers? Do we need kind of other type of regulation supervision of these, of the BlackRocks, Apollos, and so on of the world? So, so kind of pushing you a little bit into kind of policy. So kind of putting you in the spot of as being like the next Piketty. Sorry, high ambitions.
All right. And I will have to pick and choose because I don't want to go over time, and it's only 5 minutes. I think Balthasar and Waltraud, you both raised the point, the question of stagnation in different ways. So if I understood you correctly, you're saying, you know, low growth or least growth below R is sort of the definition of the Pikettyan situation. So how is this a limit to this? Yeah, and I mean, like I said, this is not elaborated and so on, but what I just want to draw attention to with this is that, you know, finance at different times of capitalist development, the financial sector does play different roles. And it always makes sense to think about all kinds of political economy questions, I think, in terms of what happens during a period of, you know, rapid development and accumulation in Marxist terms, versus, you know, how do countries get rich and how do they stay rich is the classic development literature maybe distinction, or how do they get not poor and then how do they get actually rich maybe is a different version of that. And the same type of question I think we should be asking about the role of the financial sector. What role does the financial sector play during industrialization and the formation of large corporations with huge capital outlays? Obviously, the financing function is central, and some countries it was more market-based, some countries it was more bank-based, late development, and so on and so forth. But you know, we know from Piketty that we've moved into a high capital to income ratio world, and everybody is quite rich. I mean, not everybody, of course, I mean, a lot of countries are quite rich and they have a lot of rich people in them and a lot of institutional capital pools. And so there's a nice paper by some very orthodox economists about money doctors. I think Schleifer and et al. Or Vishny et al. Or Schleifer and Vishny et al. I can't remember now. Money doctors, and they make the same point, you know, once there is a lot of accumulated wealth that wants to be and needs to be preserved, then we have this. And I think under this wealth regime, finance has become, if it's true that asset management is the dominant part of finance now, then that means that finance operates according to the logic of someone comes to Wall Street and says, I have $1 billion here, please invest this for me so that I can have steady returns year after year. Versus that's something very different from Schumpeterian capitalists coming to Wall Street and saying, I have invented this great machine, please finance it. And then the bank has to decide which of these entrepreneurs they finance. One is much more, I think, aligned with fast growth than the other. And there is, you know, it's a relatively, by comparison, conservative role for finance. It's about preserving wealth by making it so that they yield just enough so that their relative position, you know, that R stays just above G. That's all that's needed. We don't need a very high G for both the asset managers and the wealth owners to be satisfied. And that's probably not good for growth. If then you add climate crisis, you know, and you have a conservative mindset in the central sector of the economy, and then we are immediately in the realm of, okay, how are we going to get to the next regime? And I absolutely don't know this, but yeah, it is clear that not all of these claims can probably be kept at current value, you know, into the 2.4 degrees world that we're currently heading according to the latest IEA report. So there will be lots of stranding, and there will be lots of attempts by governments to mobilize money, which will also come at least with temporary, and by temporary, I mean maybe decades-long devaluation of these claims, right? There is cash pools, and that cash can be used today, but if we do mark to market, a lot of these projects may not yield enough return to be marked to market at the same level in maybe 10 years or 20 years. But at the end, there may be a planet that may not be too hot. So I think this is how we should think about the next regime. So in that sense, I would also respond to Thorsten that it's very different from how this long cycles theory thinks about the next regime. So Arrighi says the elites in the old hegemonic center redeploy their wealth, right? The Florentines or the Italians to the Dutch, they invest there, and the Dutch then finance the rise of Britain, and the British finance the rise of US capitalism. That's more or less the argument. Now, I think that may or may not be right, but I'm not too drawn into this direction if I want to speculate, because obviously climate change is an intervening variable that is so massive for asset valuations, and plus the interventions by states that really have have much more capacity than previously, and that have much more reason to try to use either that cash or to issue their own liabilities and do financial repression to pay for green transition expenses. So that I think the way we will get into a different regime is maybe more like a mix between, I don't know, destruction of asset values that happens sometimes during wars. You know, I don't want to go full Scheidel for this, but climate change will have probably an element of that and an element of wartime-like mobilization of wealth into low-yielding public assets that is bad for asset values. But then also it's true, of course, that a lot of this capital is very agile. There's a nice article in Socioeconomic Review about private equity as agile predators is the title by Charlie Eaton. They're very agile, and I'm sure they will find ways of, making it so that once those assets strand, fossil fuel assets and so on, they are back in public ownership. So there's also a scenario where the transition, I don't know, will exacerbate inequality. I definitely don't want to exclude this possibility here and then look very stupid in 50 years. Yeah, I'll end there. Thank you very much.
Fantastic. When is the book out? Not the question to ask. In 2 years. Okay, fantastic. Well, thank you so much, Ben, for opening this workshop. It's really been a rich opening discussion, and also thank you to everyone for the questions, to Eric for the discussant responses. So we have lunch now. I mean, at least 3 of us have flown in from the UK, and it's actually sunny here. So I hope we can take the lunch outside and enjoy some of the weather. And then we meet back here at